When you start a business, one of the very first decisions you have to make is what sort of business entity you will be forming. Now, the two most popular types are sole proprietors and LLCs, but what is the difference? Today, I'm going to walk you through the difference between a sole proprietorship and an LLC, and by the end of this video, you will be able to determine which one is best for you. Today's video is sponsored by Tailor Brands. Tailor Brands is an all-in-one solution for your business. Tailor Brands is the world's only comprehensive one-stop shop for small business owners, making the process of creating and running a business simple, streamlined, and easily manageable. The platform of guided tools includes LLC services, EIN, domain, website, logo builder, merch, trademark, and much more, enabling business owners to start, manage, and grow their businesses with efficiency, ease, and confidence. Now, if you decide that forming an LLC is right for your business, I want you to use the link in the video description down below to start your LLC with Tailor Brands. With just a few simple clicks, you will be able to enter in information about yourself and your business, answer a few questions about what you have already completed with your business setup and what you still need help with, and choose from a selection of options that will provide you with all the services you need to get your LLC up and running. First, let's talk about sole proprietorships. A sole proprietor is a single person that is conducting business and generating self-employed income. You are automatically defaulted to a sole proprietor the second you start earning self-employed income. Now, there is no differentiation between yourself and the business. There is no separate business entity formed. All of the business assets and all of your personal assets are all one and the same because there is no separate business entity formed. As a sole proprietor, all of that income is going to pass through onto your personal tax return and will be claimed through Schedule C of your 1040. Forming a sole proprietorship is fairly simple. This is the easiest business structure to enter into because you and your business are one and the same. You are not required to register with your Secretary of State. However, you are going to be required to follow through with your local laws surrounding conducting business. This is going to include things such as registering for a business license, obtaining a seller's permit, registering a DBA, a doing business as statement, as well as getting any sort of zoning clearance required for your office or a home use permit for your home studio. Sole proprietors are subject to paying income taxes on their self-employed income. This is going to include state and federal income taxes, as well as what is known as self-employment tax. Self-employment tax is a federal level tax which amounts to 15.3%. This 15.3% is applied to your net income, your take-home pay after you have taken out your business expenses. While a sole proprietorship keeps the business and the business owner as one and the same and doesn't form a separate entity, an LLC does. An LLC separates the business and the business owner. They are no longer one and the same, and instead the business is formed as a separate entity, as a limited liability company. This means that your business's assets and your personal assets are completely separated. You'll need to adjust how you operate your financial situation in order to make sure that these remain completely separate. Therefore, if you happen to be in an industry that is higher risk in terms of lawsuits, if you happen to have personal assets that you want to remain protected and separated from the business, then many business owners will opt for forming an LLC. LLCs also open up the opportunity to choose to be taxed differently. Sole proprietors are subject to pay 15.3% self-employment tax. Now, as a single member LLC, you are automatically defaulted to be taxed the same way as a sole proprietor. This is known as being taxed as a disregarded entity. You have a business entity that is separate from you. However, for tax purposes, that entity is disregarded and that business income flows through to your personal tax return. But as an LLC, you also have the option to file additional paperwork to change that tax status. Once your business reaches a higher level of steady and regular income, it may be beneficial for you to form an LLC and elect what is known as S-Corp taxation status. Now, electing S-Corp tax status requires filing an additional form with the IRS. Selecting S Corp tax status is going to have several additional implications. Number one, you must hire yourself as an employee for your own business. Number two, you must pay yourself a reasonable salary for the work that you are doing. And number three, you must comply with all payroll and employee regulations for your state since you will be an employee. This includes putting yourself on payroll, running payroll regularly, and registering and staying compliant with your state employment board. In many states, this is going to also mean a requirement to hold workers' comp insurance. Now here's where the tax savings kicks in. If you hire yourself as an employee and you begin to pay yourself a reasonable salary for the work that you're doing, all other profits of your business that are not included in that reasonable salary can be transferred to yourself in the form of an owner's distribution. This is simply a draw of funds from the business to your personal account. Now that tax savings kicks in here because that owner's distribution is not subject to payroll tax like your salary, and it is also not subject to self-employment tax. Therefore, you save 15.3% on that owner's distribution amount that as a sole proprietor or as someone being taxed as a disregarded entity would otherwise be undergoing 15.3% in taxes. Now, as an LLC, you're going to have additional requirements in order to stay compliant with your state. Each state has different laws surrounding their LLCs, fees that are associated with them, and registration requirements. In general, you're going to be required to pay an annual tax. In my home state of California, this amount is $800 every year. Additionally, you're going to be required to file your articles of organization when you first form your LLC. Next, you're going to be required to file a statement of information. This is required to be renewed on a regular basis with your state and has a small fee associated with it. Next, you'll need to make sure that you have in place an operating agreement. This document needs to be created because in order for your LLC's protections to be enforceable and hold up in a court of law, you need to have this document in place. So how do you decide if you should be a sole proprietorship or an LLC? Number one, do you have personal assets which you want to remain separate from your business liabilities? For those of you that own a home, investment properties, a car, etc., if you want those assets to be strictly bound to you personally and not intertwined with your business liabilities, then consider an LLC. Next, I want you to consider if you're in a high-risk industry that is subject to potential lawsuits. While we can never tell exactly what's going to happen with our customers and clients and things that we hope could never go wrong but may, I want you to think about the specific industry that you are in. Does that business industry work directly with customers, clients, consumers who have services or products given and provided by your business that could potentially result in a lawsuit? If so, and if you're in an industry with a higher potential for lawsuit, then you may want to consider an LLC. Lastly, consider the tax savings. If you're in a business that is regularly and consistently earning a higher level of income, think 6 figures and above, then you may want to form an LLC and have it taxed as an S Corp by filing that additional S Corp tax election with the IRS. Doing so will mean that you will save 15.3% in taxes on whatever you transfer to yourself as a distribution. A common question that many new business owners have is, can I start as a sole proprietor and then later convert to an LLC? And the answer here is yes. You're going to need to file additional paperwork with the Secretary of State and refile your registrations such as your seller's permit, your DBA, etc., so that they match the same information that is on your new documentation filed with the Secretary of State. But yes, you can start with one and then convert to the other later. Okay, everyone, I hope that was helpful. Now that you know the difference between sole proprietorships and LLCs, let me know in the comments down below which one you are going to choose. And remember, if you decide to form an LLC, click the link in the video description down below to form your LLC quickly and easily with Taylor Brands.